Hey, welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today I'm going to be looking at Disney stock for the rest of 2020. This video here is in April. This is after the crash and all the health concerns that are going on. Disney had to close its parks. There's some concerns about when those things will reopen. So is 2020 the time to invest in Disney? That's what we're taking a look at today. Just a reminder that my stock picks and projections are for entertainment purposes only. Please talk to a financial professional before investing in the stock market. However, if you do enjoy researching stocks and you like stock analysis, investment ideas, and personal finance videos, then please join me on the 40 Finance channel by subscribing today. Thank you to everybody who supported the channel. All right, I'll lead off by saying that in a normal year with Disney stock, it's almost a no-brainer for long-term investors. They just have so much intellectual property. Obviously, the theme parks are very successful. It's an international company that's just done an unbelievable job with their character and brand assets as far as maximizing the opportunity for each and every one of their characters and brands. Of course, in the recent history, they've purchased Marvel, Star Wars, not to mention all the Disney characters and stuff, which it seems like every year they're able to add to that portfolio. So an amazing amount of intellectual property, and they use that intellectual property to power, you know, the reason to visit theme parks, the reason to watch their shows, the reason to buy merchandise. So incredible opportunity. But here in 2020 is really the first time in a while that Disney has been in the news for kind of the negative, taking the hit with the health crisis. The parks division is a huge part of their revenue. We'll get into that in just a little bit. And you have closures there. And so people are starting to ask the question, you know, what is the long-term impact for Disney here? And should you buy Disney in 2020 while it's down, or should you wait for better times? And that's what we'll talk about as well. All right, taking a look at Disney stock today. Price stands at $101.19, and that falls in their 52-week range between $79 and $153. So you're about $53 off of the high. You see the year-to-date chart, the one-year chart posted here. And Disney is generally a pretty steady stock because they have so many shares out there, so many long-term investors. It's really hard to sort of pump and dump a stock like Disney. So it maintains a pretty steady pace. And they were cruising right along in the 153 range, coming out here in late October and into January. And of course, the world changed and we dipped as low as $79. And they've ticked back up like a lot of the stock market has, and landing today at 101. P/E ratio today at 1703. They have $6.8 billion of cash on hand versus a debt load right now of $52 billion. All of those metrics I think you could consider in flux. I've seen forward PEs as high as 40 for Disney. It's going to be very difficult to pin the distinct number on it, but we do have an earnings coming up on May 5th, 2020. So hopefully some of the metrics that we're guessing on and some of the debt load and cash on hand, all those things should be cleared up if Disney shares and discloses that information May 5th. And as a bonus to investors, at least for today, you do get the dividend of 1.74%. All right, let's take a look at some of the valuation history for Disney to figure out, or at least imply, you know, is Disney cheap right now compared to where it's been in the recent past? This chart here goes all the way back to September 2018. It's a quarterly look at Disney valuations. Again, we're in a really odd time for valuation metrics because no one's quite sure what the full impact of the virus will be on stocks, particularly ones where entire swaths of their revenue are closed or paused, as is the case with Disney. I highlighted a couple boxes in green to give us a quick look at a potential valuation comparison. Back in 12/31 of 2018, you had a trailing PE of 13, you had a forward PE of 14, and looking ahead to today, the sort of estimated trailing PE is 1911, and the estimated forward PE, at least according to Yahoo, is 3257. So you see, at least in the PE range, while Disney has taken a significant haircut, I wouldn't actually say that this is the cheapest price that you'll ever pay for Disney, because it looks back in 2018 like the fundamentals were a little bit better. That being said, you go down to price to book, which starts to give you some analysis, at least at a high level, of like, hey, how much are you paying for Disney's core assets, right? And with Disney, the core assets are very valuable because most of them are IP, most of them are intellectual property. And back in 2018, we had the price to book of 335, and today you're at 2.14. So at least in that metric, you're seeing that Disney is a little cheaper than it has been for the past several quarters. All right, checking in on the TipRanks dashboard to see what the best performing analysts are saying with Disney stock here today. Quick call out that I am a paid member of TipRanks and I fully endorse their services. I use it every single day. My affiliate link's in the description. If you're interested in signing up and supporting the channel, take a look at that. I think you'll find that TipRanks is a great guidepost in investing and reviewing stocks because it gives you basically opinions from everywhere. TipRanks is ultimately like an aggregator, so to speak, of many different analysts and sources. So if you like to get a lot of different views of stocks in one single dashboard, it's a great service for that, so check them out. As far as Disney stock and TipRanks, right now we have 9 buys and 8 holds. We have a median price target of 127.07, which is only a 25% upside from today. And I say only because don't forget, Disney took quite the haircut from a high of 153 down to today's price of 101. And basically what you're seeing with this mix of 9 buys and 8 holds is a little bit of uncertainty in the analyst world about, which way is this stock going to go over the next 12 months. That's what we're targeting here, is just a 12-month outlook. And obviously nobody is selling Disney, so that's a really good sign, because that tells us that the analysts are saying like, whoa, this thing's a tank, this thing's gonna tank, so get out while you can. Nobody's insinuating that. You have 8 holds, which kind of says, just if you're in the stock, just keep it and ride out this wave. And then of course, the 9 buys suggest that this is a buying opportunity for investors. So on the best performing analyst side, 9 buys, 8 holds, a little bit of a mixed bag, but I would consider that sentiment to be relatively positive, considering the crisis that we're in and the fact that Disney parks are closed right now. All right, next I want to cover some revenue line items from Disney's financials to kind of give you a clearer picture, if you're new to Disney, on where the money comes in and how much it amounts to. So we have this chart over here that talks about the revenues in Disney. This is directly from their Q1 revenue report, which sounds old, but Disney's Q1 actually runs through the end of December. So a little bit of a different calendar compared to the usual like January to December quarterly calendar, and then you got others that do that July to June calendar. Disney starts in Q4, which is particularly interesting this year because the full impact of the virus, I would say, probably didn't come out until the very end of what would be their Q2, roughly January to March. Those Q2 results are what what they are releasing on May 5th. But for the Q1 revenues, you can see Media Networks brought in almost $7.5 billion. That's a $29 billion pace for 2020 prior to the impact of the virus. Parks, Experiences, and Products, another, roughly 7.5. They were also on a $29 billion pace for 2020. I highlighted direct to consumer because that's where Disney Plus is included. They were on pace, or let's see, they brought in about $4 million. That total area of revenue is on pace for 16. So just to call that out, because I know Disney Plus is popular, I'm going to dig more into that on the next slide. But for purposes of this slide, the important call out here is Disney as a company makes the majority of their revenue through a sort of neck and neck race with their theme park revenue and their media networks. So media networks does not include Disney Plus. This is when you're talking about Disney Channel, ESPN, those things. So that's a beautiful line item, right? Because it's mostly IP. It's taking in your characters and your shows and your creative efforts and essentially selling those not only to media networks that you don't own, but then capitalizing on media networks that you do own by selling advertising against it. So that is probably the most sustainable line item for Disney. Now, the parks and experiences, that is the one that we have to monitor for 2020. Parks and Experiences was going to make up roughly 33% of their revenues for the year. Now they were able to capitalize, I'm assuming, here with Q1 that ran through December. They were up 8% year over year. So they got Q1 in the bag before the crisis. Q2, guessing they had a couple months, January, February, where the money was still coming in, and then somewhere around March is when those closures would have happened. So the bottom line here is 33% of revenue for parks, and that's the one I'm most concerned about right now. Figure they captured at least 25% of that in their Q1, everyone else's Q4, during basically Halloween, Thanksgiving, Christmas time. I'm guessing those are popular times to visit the park, so they were able to capture some of that estimated $29 billion. And then into January, February, which were probably slower times for park visits, but they got a couple months out of that. But now looking ahead into March and beyond, how much of this revenue stream that drives roughly 33% of all revenue, how much will that be cut? And what impact is it going to have in the long term? That's what we're going to be looking at. And the other play in there is, do parks have to change? Is there capital investments that have to come in to make parks, safe during this situation? How does that impact cost? How does that impact the amount of tickets that they can sell? Those are things that are impossible really to analyze from one person's desk, right? We're going to have to lean on Disney on their earnings report to give us an outlook of the park situation, what they're going to do to try to A, get open, and B, recover some of the potential loss here. All right, this next slide covers a little bit more of the Disney Plus. I think, me personally, kind of sarcastically, I think Disney Plus gets like way too much press compared to what Disney as a company does. So I'm just kind of illustrating that here. You see, this is again just a quarterly for Q1, and they disclose all the numbers right here. Highlighted in yellow, Disney Plus. This is the number of paid subscribers, which is 26.5 million, times the average revenue on the bottom, which is 556. That gives you 147 million for Q1 Disney Plus generated. So that equals, if you sort of extrapolate, plus I was very generous to throw in some extra dollars, knowing that signups for Disney Plus during the health scare probably boosted a little bit. So you've got, you know, about $1 billion between that and the ESPN Plus, which is much, much smaller. So I'm calling those two combined worth about $1 billion for the full financial year of 2020. All right, so just a reminder, parks generate roughly $29 billion is the expectation or the pace that they were on. Disney Plus, $1 billion, okay? So Disney Plus does not cancel out the parks being closed, not even close. It's not a bad play, but it's almost like a lemonade stand in the world of Disney. So please don't confuse Disney Plus as the savior for the company during this difficult year. All right, so my bottom line with Disney stock here in 2020, first, park closures are a massive hit. They cannot be overstated. And what becomes of the park closures over the next 6 to 12 months is really going to determine the future, not only for Disney's revenue, but it's going to determine the future of their stock price as well. Next, we have the summer movie release schedule, and this one's difficult for me to really analyze, but if movie theaters remain closed, then what happens with all those revenues from upcoming titles that were supposed to come out? Summer movie release schedule could definitely impact revenues for Disney. We'll see what happens there. Next, we gotta wonder about the long-term impact of social distancing on movies and parks. But let's pretend everything opens tomorrow, right? Like, what modifications are gonna be made, and how does that impact revenue over the next couple years? That's gonna tell us how much of an upside Disney stock has from its current price. All right, number 4 I already covered, and that is Disney Plus is not the savior for Disney. However, if you are looking for a savior, then Disney IP is definitely one that can float this company for a while, assuming they pull back on their costs, which I'm sure they're already doing. You know, reselling branded plays for stuff you already own is the easiest way to create money out of thin air. All right, so final call for me is right now with the things we know with Disney, and May 5th is going to be an important date. Target price for me is in and around $100 where it stands today. Ideally, you go under 100 on the next dip. If you can play under 100 and hold Disney for 2, 3, 5 years, I feel pretty good that this company is rock solid on the stuff that they own and how they make money. But I don't see this as any kind of a short-term play. If you're getting into Disney, buy it as low as you can. If you can get under $100 and throw it off and not look at it for 5 to 10 years, you are absolutely going to make a lot of money, especially when you include the dividend. But this short term, 1 to 2 years with the health scare is really going to impact revenues, and those negative headlines are going to keep the stock price down, in my opinion, at least for the next 18-24 months. Guys, hope you enjoyed this video. Give me a like and subscribe if you do. I'll see you on the next video.